Thanks, Greg, and welcome everyone. Like Greg touched on, I'm here to discuss finance and interest rates in particular and what's driving interest rates at the moment, and also touch a little bit on lenders and the best way of getting your home loan approved. So we'll start off with the Reserve Bank official cash rate and where it sits today and where it has been previously. So my pointer works, there we go. So anyone who took out a home loan in the early 90s would know the pain of 18% interest rates or cash rate at 18% all the way down to the record lows of 0.1% of recent times. So this is the end of the spectrum really. This is the record highs and the record lows. But what you will see here predominantly is that the cash rate generally sits between that 4 and 6% mark. So from about 1992 through to about 2012, it sat in that 4 to 6% range, which is where the Reserve Bank would prefer it to be. Since 2010, there has been no interest rate rises up until 3 or 4 months ago. So I've had the opportunity to sit in with in some forums and some seminars with some economists of recent times, and their general feeling has been that the Reserve Bank left interest rates too low for too long, and we're now playing catch up, which is why the rates have risen so quickly and so high, which has only ever really been done at this rate once before. As we know, previously rates were down to 0.1% only a couple of months ago. Now we're at 1.85. First rate rise since November 2010. We've not seen an increase like this since 1994 when rates went from 4.75 to 7.5% over a 4-month period. Where will the cash rate end from here? Well, most economists are saying 3% or in the low threes. But like I said previously, the Reserve Bank tends to have it around that 4 to 6% range is where they feel comfortable because they feel there's then scope to move if the economy needs any tweaking in the future. With the forecasting, it is prudent to be very careful in what you hear and what you listen to, even what I'm saying here tonight, because it is forecasting. It's a bit like a long-range weather forecast. You wouldn't necessarily believe it. So the Reserve Bank governor's come in for a fair bit of criticism in recent times, saying that he didn't think rates would move until mid next year. But obviously that's all changed. And they will move solely on data, and that's what they're driven by. So they don't care what they said 3 months ago, 6 months ago. And like Greg said, we haven't been, I had one of these nights for 2.5 years, and I did previously look at my notes from the previous meeting that we did. And he was on record then as saying the next rate movement would be up and not down. And then we saw 3 rate reductions after that time. So they will change their mind. They're not accountable to anyone effectively. They'll be driven by data and make their assumptions on that or their opinions on that. So during the pandemic, the government and the Reserve Bank pumped a lot of money into the economy. So hence we came out of the economy come out of the pandemic a lot stronger than we thought we were going to. So the economy didn't have the big effect on the economy it had. Things like JobKeeper and the like kept things ticking over. So we've seen strong demand and supply issues, which is fueling inflation, which is making things difficult in the sense that higher inflation means your real income is falling. So even though your pay hasn't changed at all, hopefully it hasn't gone down, but if it hasn't gone up, your real income is falling because inflation and the cost of living is taking more of your income each month. So for the last 12 months, the year-to-date figure for inflation has been 6.1%. Wages growth has only been 2.6%. There were figures released today on the wages growth. But inflation in June alone sat at 6.8%. And that was the last quarter it was actually recorded at this stage. So when the next quarter comes up in September, it's likely the underlying inflation rate will be higher again, which will then again mean likely further rate increases moving forward. Getting on top of inflation isn't an easy thing to do, and banks and governments haven't had to do it for a long time. We haven't had a problem with inflation for a really long period of time. And if it does hang around for longer than expected, it can mean further rate rises and even than what they are talking about now. The issue with interest rates isn't solely happening just here in Australia. It's actually going on around the world. Inflation is going on, having a real impact in other countries, more so even so than here. But reserve banks and central banks around the world, really their only way of combating rising inflation is to raise interest rates. And that's going on everywhere. As you've probably read and seen and heard, just in the news, just in general, that's going on. I think underlying inflation in both the US and the UK is significantly higher than what we're dealing with here in Australia. So that's the effect of really inflation and what's having on interest rates and what it's doing to you as a consumer and on your bottom line every single day. But more so now, I just want to touch on what it's like to get a home loan now, so what it was, say, 12 months ago, 18 months ago. Rising interest rates and cost of living makes servicing on a bank's calculator more difficult. So what that means is when you come to go for a home loan, you may well be asking for $700,000 for argument's sake, and your interest rate previously was 3%, 2.5%, what you might have been getting. Now your interest rate will be 4, soon might be 4.5. And when a bank assesses your application, they don't assess it at 4 or 4.5%. They assess it at something like 6.5 or 7%. So each time rates go up, the serviceability calculator goes up as well, which means the reason that the banks do that is because they want to make sure if rates continue to rise, that you can afford to make the repayments if rates continue to go up. And you must pass each lender's servicing calculator to be able to qualify for the loan. Each lender does it differently, and you'll be surprised about the difference between what one lender will lend you and what another lender will lend you. So if you bank with a certain bank and they say, no, we can't give you that much money, there may well be another bank out there that can. It's not uncommon for that to happen. It's not the same across the board everywhere. But the way to maximise your borrowing power is to minimise credit cards, Afterpay, Zip Pay and those things. A lot of people come to me and say, I've got a credit card. Well, so they don't even mention they've got a credit card. It's a $10,000 limit. I haven't used it for 2 years, so don't even think about it. But when the bank does their calculations and when they do their due diligence, they'll see on your credit file you've got a credit card for $10,000 and that credit card hasn't been disclosed. So one is they want to know why you haven't disclosed it. And then they'll take into consideration a minimum monthly payment on that credit card of about $300 to $350, which then once again affects your borrowing capacity because that's an extra expense you have. So to minimise the amount of other debt, credit cards, Afterpay, Zip Pay, those sorts of things are pretty important if you're looking to get a home loan, if your serviceability is tight, okay? Credit teams are far more flexible than they were 2 years ago. Banks got rather panicked during the pandemic, it's fair to say. Credit teams got particularly panicked in the way they assess loans and the way they approve loans. That has now all changed. It's back to really more pre-pandemic levels of being able to get finance and the ease of dealing with credit and getting them approved and the level of information you need to provide. But having said that, due to the rising interest rates and cost of living, it is harder to show serviceability on a bank's lending calculator. An example is 18 months ago, I had a client who wanted $50,000 out of his home just to get a car, and we had to give all sorts of information on what the car was, what he was looking at, provide that to the bank so they were satisfied that's what the money was for, whereas now banks are openly saying, we'll give you cash out as long as you can afford it, as much as you want, some lenders. And finally, there is still very strong support for first home buyers. So if you're going to get in the market, haven't owned a home before, there's still significant stamp duty reductions here in Victoria. And the first home guarantee scheme, which a lot of you may not have heard of, it is an excellent scheme for first home buyers if you have a small deposit. So you might only have a 5% deposit and you might be looking for a place as a first home owner that might sit under $600,000 for argument's sake, so there'll be no stamp duty. And with the first home loan deposit scheme, you'll have no mortgage insurance by only having a 5% deposit. It's a very good scheme. There's a lot of places. It's just been relaunched again this financial year with 3.5 times more places than there had been previously. So shouldn't run out of places in the scheme, but it's an excellent scheme to be a part of if you're looking to get into the market and for a first home buyer. So that pretty much covers me off. So thank you for your time. Any queries, I think there'll probably be questions later on, but I'll be here. You can speak to me after. My cards are on the table, so anyone that wants to grab a card and give me a call down the track, feel free to. But I'll be around for anyone who wants to speak to me. And otherwise, Russell will give you a very informed commercial and industrial market analysis. Thank you.
Thanks, Rob, as always.